Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another exciting episode of the What Matters podcast, where we delve into the insights and experience of leaders in the financial planning industry. I'm your host, Mike Mershazadeh.
And I'm Ashley Ward.
And today we have the privilege of speaking with Dick Pfister, the founder and CEO of AlphaCore Wealth Advisory, headquartered in La Jolla, California.
Dick has over 25 years of experience in the wealth advisory and financial services industry, with an emphasis on diversifying traditional portfolios with alternative strategies. In 2015, he founded AlphaCore, which has become a leading wealth advisory firm. Welcome to the show, Dick.
Thanks for having me, guys.
Well, we're excited to have you with us today. Let's start by delving into your journey and your origin story. Could you share with us how you founded AlphaCore and the experiences that shaped your path to establishing your own wealth advisory firm?
Of course. Thanks for asking, and thanks again for having me. I guess I'll start really early days. I'm actually originally from the Midwest. I'm from Wisconsin. Ended up going to school in San Diego, trying to get out of the cold and avoid the cold, which a lot of us do, I guess, Ashley.
Yeah, we know about that.
So I ended up going to school at University of San Diego and got a business degree. And when I graduated, I got a job with a firm that many of your listeners probably know of, named Dean Witter. Eventually got bought up by Morgan Stanley. But back in the early 90s, I was a floor trader for Dean Witter in Chicago on the Chicago Mercantile Exchange, and was thrown kind of headfirst into the world of futures and derivatives at a very young age, and really got my education on what true risk management meant by some of the leading money managers in the world. And this is the mid 90s, 93 to 98. And some of those managers weren't that famous then, or not yet legendary. Some of them were like Paul Tudor Jones and George Soros and Bruce Kovner and Bruce Campbell from Campbell. And there were some great money managers that were using futures to diversify and to hedge their exposure. And what happened for me was I got hooked on the world of high-end, kind of best-of-breed money managers from a very young age. But I still wanted to move back to San Diego because I was cold again in Chicago. Ended up becoming a research analyst with my former partners. And what we realized in the late 90s is that there were some great alternative strategy managers that weren't really available to what I would call the less than qualified purchaser type of client, less than a $5 million net worth. So if you wanted to get money with some of the biggest and best money managers, you would have to put a $20 million minimum up. So most of them were relegated to pensions and endowments in large institutions. And what we decided to do was create a firm that pooled assets together to lower the minimum and democratize access to best of breed alternative strategies. And the firm I was a part of was called Altegris Investments. And that was early 2000s. And at that day and age, you really couldn't get access to the best in private equity or private credit or hedge fund strategies. And we were early on in the genesis of providing access throughout the 2000s. We were fortunate enough to grow that firm quite large, and we ended up selling it to two private equity companies. When that happened, I was still working full time for my previous firm, but I needed a financial advisor to help me, because if I was going to continue to work, 10 hours a day, I wanted to understand that my wife and my kids were being taken care of from a financial planning perspective. So I met with some local shops, some pretty well-known names in San Diego, nationwide firms that you would all know the names if I shared them with you. And I sat down with three of them, and my wife and I met, and we said, okay, I'm married, I've got 3 children. What would you do with this liquidity that I just got because we sold my old firm? And for the most part, they were all pretty good at gathering financial data. They would say, let's look at what your expenses are, your income, your total net worth, your property, and let's talk about your goals for potentially saving for college or retirement. So kind of the financial planning 101 questions. I think most advisors are pretty adept at gathering that data. And once they gather that data, they would put together a goal and say, okay, well, you should probably make, let's say, high single digit returns. If you can make that for the rest of your life. You won't run out of money. In fact, your money will compound at this rate. And then I would say, well, what's the investment philosophy? What's the asset allocation to get to those goals? And for the most part, they all said something very similar. And that was a combination of stocks and bonds. Let's call it a 60-40, which everybody kind of is familiar with today. 60% stocks and 40% bonds. And as you get older, we'll give you more bonds and we'll lessen your weight to equities. And for me, that was 2014 and 13. And I looked at that and I ironically thought, for me at the time, I was in my late 30s, early 40s. I thought that's actually too risky for me. And they were kind of taken aback because they're like, well, you come from the world of alternatives. That's got to be much more risk than a 60-40. And I said, well, actually, I've lived through the 1998 long-term capital management debacle. I lived through the tech wreck of the early 2000s where we lost 50 or 60% of your money. I lived through 08 where we lost a lot of money in equities. So equities every, between 5 to 10 years have a big pullback that people are going to have to withstand that drawdown. And then on the fixed income side, when rates were about 1%, I was either diluting myself in the fixed income piece of a portfolio, or if rates rose, I would have had much more risk on the fixed income side. So those two big asset classes of 60-40 to me weren't giving you the full diversification that most clients deserve. So what I sat down and said, well, there's a big void in the wealth advisory space on the investment side of reaching your financial planning goals. And so I decided to launch AlphaCore, which uses alpha generators. Let's call those alternatives, not just one manager, not just one strategy, but multiple types of alternative asset classes and alternative strategies at the centerpiece of your portfolio. And then we put long only stocks and bonds around that core, or beta around the alpha. And that's where the name AlphaCore comes from, right? So alpha at the core of our asset allocation. And since then, we've grown from zero assets in 2015 to closing in on $3 billion today. And we've got a team across the entire country.
So tell us about that. You guys have grown your AUM to $3 billion now. How long is it taking you to do that? What was your strategy? Did you guys grow the company organically, inorganically? Can you talk a little bit about that from the maybe the growth level, and then the level of how you guys brought clients on?
Sure. So we're not quite 3 billion. We're almost there. We're right there. So we're
tomato. Well, we'll round it up for you.
So when I launched it, I was the actual first client of AlphaCore, me personally and my family. So you could say we definitely eat our own cooking, right? All of my personal assets are here, and a lot of our team members, all their assets are managed by AlphaCore Wealth Advisory. So going kind of from that first dollar to the first 100 was word of mouth, people that we knew, were client referrals and centers of influence. And that was all really Southern California based. So attorneys, CPAs that heard what we were doing, understood it, really, really resonated with them. And the original philosophy, which still stands true today, sounds somewhat vanilla, which is we call it winning more by losing less. And it's pretty simple, right? So if you have $1 million and you lose 50%, you now have $500,000, and you've got to make 100% of your money just to get back to break even.
Right.
So you have to hit a home run by definition just to get your money back. So, and that's just the rule of, that's the rules of math, right? As you go down more, you're going to have to make more money to get back to break even. So the philosophy is if you are mitigating the loss or losing less in those downdrafts, then you can actually get back to new highs much faster. So the concept of how do you do that, right? That sounds conceptually great, but how do you actually mitigate the downside? Well, it used to be that bonds would provide that protection. If equities would go down, bonds would go up. And that's essentially what started happening right after the tech wreck. The Fed lowered rates. They did QE1, they did QE2, they did QE3 after 08. And so they had this essential, kind of alpha or crisis alpha that bonds would provide when stocks would go down. We don't believe that the next 10 years are going to look like the last 10 years. And so we think you need this third leg of the stool, which we call alternatives, that provide this diversification. And because of that story, like that's how more and more advisors and more clients started to join AlphaCore. So we've attracted not only clients, which is obviously our highest priority, is making sure we do what's right for the client first, but other advisors who are looking to get exposure to the world of alternatives or non-correlated returns reached out to us as well and said, I'd really like to help my clients with these things, but I don't have the expertise that the AlphaCore team does. And so we would have natural advisors reaching out to join our team to get access to the strategies and philosophy that we have at AlphaCore.
Wow. So you guys did primarily 100% organic growth there.
We at the outset for the first, call it 4 or 5 years, 100% organic. And then over the last 2 years, we've done 3 strategic mergers. And what happened over those 2 years was advisor would call and say, I'm actually in a process right now looking to be acquired, but I want to go with a firm that I'm strategically and philosophically aligned with. And even though we hadn't marketed as an M&A kind of shop, they would reach out because they're philosophically wanted to have this type of exposure, but they also know that we built out the operational support, the compliance support, and the marketing support. And so they say, well, if I can get kind of the best of both worlds, where I get asset allocation help, but also everything else, call it the plumbing of everything else, we would rather go with a firm that we're philosophically aligned that can actually do an acquisition like that as well.
And so when you merged, you said 3 different firms to AlphaCore. Are they all part of AlphaCore? Do they go by their own DBAs, or they're one and all there?
Fully AlphaCore, branded AlphaCore. They're team members of ours, and anybody that we're doing an acquisition with typically has equity, and they're equity partners of AlphaCore. So it's part of us that we want to keep that cohesiveness, the same culture, the same philosophy. It's really important to us, and that's typically very important of the advisors we bring on too.
I like that.
And so now you guys are at roughly $3 billion. How many advisors are at AlphaCore?
We have 18 advisors, and then we've got a team of financial planners as well. So we have a financial planning team. We've got business development officers, and then we've got a client service and operations team that I think is, best of breed in that space. And we've got a compliance team, and then we've also got our research team, and obviously they all work in conjunction with one another. A lot of people will think of us in the vein of research, and they must know their alts and they must understand, which is definitely true. But you really can't do asset allocation to alternatives right unless you understand all components of the portfolio and also understand the entire planning side of a well-rounded wealth plan. So we have to do financial planning before we get to the investment side to understand what kind of strategies might fit to actually reach the goals that are in a financial plan. So they all work together. You can't just be an expert in investments and then miss out on something you should have known about their tax consequences. And the same thing holds true. You can't be great at charitable giving and excellent at giving trust advice, but then put in a rudimentary 60-40 stock bond blend that mitigates all the great work you did on the wealth planning side. So you've got to bring those all together across multiple divisions.
And shifting a little gear there, out of curiosity, how many total team members do you guys have?
Just over 40 now. It's growing every day, so it changes pretty rapidly. We're bringing on a couple more team members in the course of the next 2 months as well.
I like that. You're actually right, almost at that pivotal point of 50, right?
Yeah.
Yeah, where it's not considered a small company anymore. Yeah. Congratulations, by the way.
Thank you.
Really cool.
It's been fun. It's great when you bring on good people that you like working with, and we have we wrote up these values. There's 7 AlphaCore core values that we wrote up, and when we're bringing on people, we obviously show them to them, and they have to embody these values. The first value is do what's right for the client, right? That's the number one value. And you think, well, as a fiduciary, that should be obvious, but in some cases, it's not easy, right? To do due diligence and then put alternatives into a client portfolio is not simple, right? You have to do the research. You might have to do subscription documents. You have to do the tracking of that investment. So it's not easy, right? But it might be the best thing for the client. And so when you start with that in mind, it might be harder and it might cost more, and it might have more ops people to help you with that. But if you start with that base, it kind of leads the way. And the other 6 values we have are how we treat each other here. And some of them are probably obvious too. One is check your ego at the door and make sure that, because we have a lot of expertise here, and somebody might think, well, this is the right way to do a plan, or this is the right way to use this strategy or another. But if there's a lot of knowledge to gather from other team members too. So, and then the final one is keep things fun. So we do have a lot of great team events and, kind of all hands meetings every 2 weeks. So we keep it fun too.
I like that.
Yeah, I love that. So building a successful firm undoubtedly comes with its fair share of challenges and lessons. What are some of the key lessons that you've learned through your entrepreneurial journey and through the genesis of AlphaCore?
That's a good question. I would say that it sounds kind of trite today because there's books written on this, but it's a matter of being consistent, showing up every day. And it's those little things. Like I actually, when we interview people, I'll say something. You could stand out if you come in the office every day on time and you stay till everybody's done. That sounds so obvious. I mean, because I'm now 52 years old, I feel old, but that's so obvious to me. If you do that, you will be ahead of 50% of the people that are out there in the marketplace. Now, if you can actually be an expert in the field that you're in, whether that's operations, customer service, research, advisory, planner, that just puts you the next step ahead, right? So to me, it's that tenacity to just keep coming back every day, even if you're tired, even if you're frustrated that day, or you made an error, whatever that is just showing up every single day, ready to do your job, ready to play the game, whatever it is you're doing. Those are things that, unfortunately, I think are lacking in today's environment, but it really does set you apart. So yeah, and not every decision we've made since I launched AlphaCore has been the right decision, but when they're the wrong decision, you hopefully learn from that mistake and you move on, right? And those are kind of tried and true, I think, truisms that people should understand. And I think that I've got 3 children. They're all teenagers, and I tell them the same things that I would tell any team member that works at AlphaCore. They're very similar lessons in life.
Yeah, consistency is key. That's for sure.
Yeah.
What about some of the specific challenges that you've potentially faced? Or, I mean, I'm sure that there was definitely challenges merging 3 organizations into yours just within the past 2 years.
Yeah, there's the values that I was mentioning earlier are critical. They're not just the 7 values that we put on a piece of paper and everybody instantly embodies them, right? It's a day-to-day integration of those values in your work life. So those are challenges, right? If somebody thinks that that they should allocate in a certain way, but in our investment committee we wanted to go another way, or somebody thinks that this tax strategy is the right one and this one's not the right one, there's different ways to approach the same problem, right? And you have to find the balance. Those are the other challenges. By growing in the way we've grown, is we've taken the profit of AlphaCore and put it right back into the business, right? So by hiring more people, hiring more staff, getting more technology. And so, that's always a balance too, is like, how much are we going to reinvest? Well, for our history, for the most part, it's been almost all reinvested, just to make sure that we have high level customer service as we grow our teams. So those are, decisions that are kind of on the business side, but they definitely have ramifications to our clients. And like I said, if you put your clients first, you're going to say, well, I probably need another customer service person, or I probably need another planner, or we need to invest in this technology to make things more streamlined for our clients. So those are challenges that happen every day, right? So, if you're with the right people and you're kind of all rowing in the same direction, it makes it easier and a little bit more fun to get through those challenges.
Let me ask you this: how you said you have 3 teenagers? What are their ages?
I've got an 18-year-old, a 17-year-old, and a 15-year-old.
Wow.
Yeah.
Wait, are all 3 of them in high school right now?
My oldest is a freshman in college, right? She's at Wake Forest, and then I've got my second oldest is a junior in high school, and then I got a freshman in high school as well.
Wow, how cool!
Yeah, great time. It's really fun.
Yeah, I was hoping you were going to say that they were all three in high school at the same time, right?
That's
They
cool.
were. It's a busy time in my house. My friend, they all play sports, and my wife and I are heading to different sports events every night, every weekend, every tournament, and then my oldest plays sports in college as well. So those are great days. They're really fun.
Real cool. So, talk to us about the future of AlphaCore. What do you see? 3 to 5 years down the road. What do you guys see? As far as growth goes.
Sure.
Is there an AUM number that you have in mind, a client number that you have in mind, a growth trajectory that you have in place? Can you elaborate a little bit on that?
Sure. We've fortunately we took in a strategic minority partner late last year, and that was a goal of mine since 2022 was to bring in a firm that could actually help us grow and help us with strategic planning, help us with a variety of things across the board from M&A modeling to training of our teams to marketing to a whole host of things that this team is involved with us on a day-by-day basis, and also gives us some kind of dry powder to actually do some M&A in a more meaningful way in the future. So this team is great. Their firm name is Constellation, and I can't speak highly enough about that.
Very familiar with them. Yeah.
Yeah, great shop. And the people they brought on board are just second to none, and I really love working with them. For us, I didn't want to give up control of AlphaCore. I still wanted to be very much involved in the day-to-day and the direction of AlphaCore, but I wanted somebody on my side in the ring with me, and they're definitely like that. So for us, we're going to be growing still, obviously organically is a very important part of what we do. And that's going to be in the different cities that we're in. We today are centered in Southern California, but we do have an office in Denver, and we have an office in Greenwich, and a small presence in Scottsdale and in Sacramento. So I'll see we'll be expanding into different cities. And that will either be from just direct hiring of advisors and teams or doing some M&A across different cities as well. That's going to be a critical component. So our AUM target is large, but we won't do that kind of haphazardly. We want to make sure that strategically we're adding advisors that are philosophically aligned and team members that are philosophically aligned. And so that actually, shrinks the filter a little bit because they've got to understand who we are and really want to be a part of the team. They're not keeping their brand. They're not keeping the way they do business. They're going to integrate with our tech stack and integrate with our research team. And I think a lot of the people that do that have found a lot more upside to their business when they join.
Okay.
And what trends do you foresee shaping the future of wealth management? Especially considering the evolving needs of clients. Any trends, technologies, strategies that you really see shaping the future?
Definitely. I mean, obviously, I'm biased to this answer, but I think that today a lot of advisors use alternative strategies. But I think in 10 years, I think every advisor will use them. We might not even call them alternatives at that time, but we might have a different name. It might be just private markets, public markets, correlated and non-correlated, right? And that might help people digest what these are and kind of demystify the world of alts, which I think I've tried to do for the last 25 years of my career, is to demystify what these managers do. But I think that's going to be really critical. I think that the interest rate environment that we're in now, the geopolitical concerns that we have going forward, either domestically or internationally, and then the volatility of the markets will kind of warrant advisors utilizing strategies that are different than they would have used, even 5 or 10 years ago. So I think that's going to continue, which means that there's going to have to be much more operational efficiencies that advisors embrace. Technological solutions have gotten much better than they were 10 years ago, but I think they're going to continue to get even better, right? So you'll probably see the advent of using AI when you're using searches for managers, searchers for how you're going to blend the strategies together, risk factors and how they relate to one another across, say, traditional stocks and let's say alternatives and traditional bonds and alternatives. So I think that will evolve and to make advisors' lives easier, but also clients and understanding these instruments much, much easier. So that'll be, I think, a big growth area for the wealth advisory space. And then there'll be other things to do with AI with regard to commentaries and writing, market outlooks. Those types of things are going to start to evolve even more too.
Thank you.
Mhm.
And so, what do you see the future of AI, and I guess doing for AlphaCore itself? Do you guys see AlphaCore taking advantage of some of these AI components that are coming into place, or are you already using them?
Yeah, I think it's a difficult situation to foresee because there are still compliance hurdles you've got to make sure you understand, right? So if you're going to write a commentary, right? We have research analysts and they write great material. The world of AI hasn't really caught up to that, right? The data that's even in the open AI world is delayed. It's 2 to 3 years old. So you can't really use that, right? I find a hard time believing that, let's say, Bloomberg and FactSet and the rest are just going to give up their hold on their data and say, yeah, of course, go for it in the API world and start using Bloomberg data. I'm pretty sure that's not going to happen for a while. So writing an up-to-date economic piece using, let's say, ChatGPT is not quite there yet. Now you can get the idea generation. That's interesting, right? But they're still going to have this human component to AI that I don't think is going away anytime soon. The other part of this is that you can use tech only so far, right? And at some point, an end client wants to talk to a human being. And to us, that's a real value add. When somebody calls, you pick up the phone. When somebody emails, you respond with a human. And so I don't know if you're going to go all that way in the necessarily, very near future. I think AI is getting so much better that in maybe 10 years, you won't necessarily know if you're talking to a human or not. But for the time being, I think in the wealth advisory space, where money ranks as kind of top 3 most important, topics for a client, they're going to want to talk to humans.
Yeah, I totally agree with you that the human aspect, it's indispensable in wealth management or in any industry really. But you raised a good point there. In 10 years, who knows if we'll be speaking to a human when they pick up the phone, which is kind of crazy to think about.
It really is. It's funny. We have, if you think about like kind of the hierarchy of things that are important in people's lives, and that could be your family and your friends, right? It could be religion, and it can be health and your money, right? These are things that I think people are still going to want human interactions with. They're the top 5 or 10 things in your life, and it's hard to kind of imagine that those will go away. It's humans and human touch and human feel and human sight. That's it's going to be difficult to replace.
Yeah. Well, shifting gears a bit, given your expertise, what specific investment opportunities or sectors are you currently excited about, considering your focus on diversification and alternative strategies?
Yeah, I think it's, there's the good news about 2024 is there's a lot more exciting things today than there was just 2 years ago. 2 years ago, I would have never said that traditional fixed income is exciting. Today, we look at you can actually earn 5-6% in traditional fixed income, even liquid fixed income. So that becomes interesting for clients, right? Where you can actually keep up with inflation in a liquid format. The other part that's interesting, even in that world of fixed income or in debt or private credit, that world can complement a liquid fixed income portfolio. So private credit and private debt, something we've had exposure to for the last 5 years. I think that's going to continue to grow. And then if you think about the vintage for private equity and venture capital right now, if you had never had exposure to private equity or never had exposure to venture capital, and your portfolio can withstand some illiquidity, this vintage in 2024, I think is going to be really interesting the next couple of years, because that world has seen small write-downs, not a tremendous amount of write-downs in private equity. Venture has seen more, but where you can get into really interesting ideas in biotech, life sciences, healthcare in general, and get it at really interesting prices. And if you have a portion of your portfolio that you can have for 5, 7, or 10 years, I think it's going to be a really interesting entry point for that world.
Thank you. Yeah.
Mm-hmm.
So let me ask you this. What do you think the economic or the landscape of the economics looks like, right? So much has taken place over these last several years. We have, the debt is, twice what it was even 5 years ago, right before COVID. We've seen the 10-year Treasury, go from 0.5 all the way up to 5. Where do you think interest rates are going for the consumer? Where do you think the market's going to go? Give us your broad outlook. I'd love to hear it.
Right. It's obviously hard to make predictions 6 months, 12 months. I think if you had asked a lot of economists 24 months ago, would the stock market be going up in even 2023 or 2024? Many were saying no, because it wouldn't be able to withstand higher interest rates. And the fact that the Fed raised from 0 to 5% that quickly, not many economists were predicting a rally in 2023. Right. And then furthermore, to predict another rally in 2024. So it's hard to make a linear relationship between those two things. For us, what we would say is there's going to be much more dispersion. Right. And dispersion we define as there's going to be certain sectors that do tremendously well and certain sectors do tremendously poor. And you can kind of see that it's happened over the last 18 months. Right. You've got this world of tech and the whole semiconductor space has gone off the charts, right? And then you've got other sectors that are down. So there's a big chunk of the S&P that's still down and not growing earnings whatsoever.
Right.
That's like the middle of the 90s, right? If you look back in the 90s, interest rates were higher. The average rate, I guess, at that time was around between 5 and 5.5%. Kind of more normal interest rate environment, which causes much more dispersion in stock prices. Also causes dispersion in bond prices. So what does that mean for us? Well, that means you're probably going to want to lean towards more actively managed strategies. Where actively managed strategies were really thrown out to the woodshed for the last 15 years, right? Passive was the only way to go, right? Long only, low cost, passive strategies. We think that the next 10 years, you're going to want more active strategies. And those active strategies can be long only, but you might want to apply a tax loss harvesting strategy on your equities because there's going to be a lot of opportunity to take some losses while you harvest your gains, right? So to me, those strategies are going to be interesting. Long short equities are going to also be interesting. And that doesn't necessarily give you an answer that says, oh, we're going to be in a bull market for the next 2 years or 3 years. It just, to me, tells you there's a lot of uncertainty and there's so many things that could go on, especially in this year where we're having an election. So you're much better off, in my mind, to have more actively managed strategies than just passive.
Thank you.
Well,
I appreciate
that wraps up our questions for today. But thank you so much for joining us, Dick. It's been a pleasure having you on the show, and we really appreciate you sharing your insights with us and our audience. Thank you again.
Thank you so much for having me, guys.
And to our listeners, thanks for tuning in to another exciting episode of the What Matters podcast. Stay tuned for more episodes with enlightening guests on what really matters in finance. Thanks, everyone.